An interview with Bruce Kovner, the world trader. Today, Bruce Kovner may well be the world's largest trader in the interbank currency.
In 1987 alone, he scored profits in excess of $300 million for himself and the fortunate investors in his funds. During the past 10 years, Kovner has realized a remarkable percent averaged annual compounded return. $2,000 invested with Kovner in early 1978 would have been worth over $1 million 10 years later. Despite his incredible track record and huge trading size, Kovner has managed to keep a surprisingly low profile. He has assiduously pursued his privacy by steadfastly refusing all interview requests. "You might be wondering why I consented to this interview," he said. "As a matter of fact, I was, but I did not want to raise the question. I had assumed that his agreement reflected a vote of confidence and trust. 7 years earlier, our paths had crossed briefly when we both worked at Commodities Corporation, he as one of the firm's principal traders, I as an analyst." Kovner continued, "It seems like I can't avoid some publicity, and the stories are usually distorted and fanciful. I thought that this interview would help establish at least one accurate record." Kovner hardly fits the intuitive image of a trader who typically holds positions with a total face value measured in billions of dollars. With his incisive intellect and easygoing manner, he reminds one more of a professor than a giant-scale trader in the highly leveraged currency and futures markets. Indeed, Kovner started out as an academic. After graduating from Harvard, Kovner taught political science courses at Harvard and the University of Pennsylvania. Although he liked teaching, he was not enthused with the academic life. "I didn't enjoy the process of always confronting a blank page in the morning and thinking of something brilliant to write." In the early 1970s, Kovner managed a number of political campaigns with the idea of eventually running for office himself. He abandoned politics because he didn't have the financial resources or the desire to work his way up the political ladder from committee jobs. During this time, he also worked as a consultant for various state and federal agencies. Still searching for a career direction, Kovner shifted his attention to the financial markets in the mid-1970s. He believed that his economics and political science education provided the right background, and he found the idea of analyzing the world to make trading judgments tremendously appealing. For about a year, Kovner immersed himself in studying markets and the related economic theory. He read everything he could get his hands on. One subject he studied intensively was interest rate theory. "I fell in love with the yield curve. The yield curve is the relationship between the yield on government securities and their time to maturity. For example, if each successively longer-term maturity provided a higher yield than a shorter-term maturity, for example, 5-year T-notes at a higher yield than 1-year T-bills, the yield curve would reflect a continually rising slope on a graph." Kovner's study of the interest rate markets coincided with the initial years of trading in interest rate futures. At that time, the interest rate futures market was relatively unsophisticated, and price distortions, which would be quickly eradicated by arbitrageurs today, persisted over time. As Kovner explains it, "The market hadn't become important enough for Citibank or Salomon Brothers, but it was important enough for me." One of the primary anomalies Kovner discovered was related to the price spread, or difference, between different futures contracts. Futures are traded for specific months, for example, March, June, September, and December. Given the prevailing phase of the business cycle, interest rate theory predicted that the nearby contract, for example, March, should trade at a higher price, lower yield, than the next contract, for example, June. Although the nearest two contracts did indeed tend to reflect this relationship, Kovner found that the price difference between more forward contracts often started trading at near zero levels. His first trade involved buying a forward interest rate contract and selling a more forward contract, in the expectation that, as the purchase contract became the nearby contract with the passage of time, the price spread between the two contracts would widen. That first trade worked just according to textbook theory, and Kovner was hooked as a trader. His second trade also involved an intra-market spread, that is, the purchase of one contract against the sale of another contract in the same market. In this case, he bought the nearby copper contract and sold a more forward contract in the expectation that supply tightness would cause the nearby copper contract to gain relative to the forward position. Although his idea eventually proved right, he was too early and lost money on that trade. At the end of these two trades, Kovner was still ahead, with his original $3,000 stake having grown to about $4,000. And now the interview. My third trade is what really put me in the business. In early 1977, an apparent shortage was developing in the soybean market. It was a demand-driven market. Every week the crush was higher than expected, and nobody believed the figures. The crush is the amount of soybeans processed for use as soybean meal and soybean oil. I was watching the July-November spread, that is the price difference between the old crop July contract and the new crop November contract. Since it looked like we were going to run out of soybeans, I thought that the old crop July contract would expand its premium to the new crop November contract. This spread had been trading in a narrow consolidation near 60 cents premium July. I figured I could easily stop myself out just below the consolidation at around a 45 cents premium. At the time, I didn't realize how volatile the spread could be. I put on one spread, that is, bought July soybeans and simultaneously sold November soybeans near 60 cents, and it widened to 70 cents. Then I put on another spread. I kept on pyramiding. How big of a position did you build up? I eventually built up to a position of about 15 contracts, but not before I had to switch brokerage firms. When I started out, I was trading in a small brokerage house. The head of the company, who was an old floor trader, went over the trades every day and spotted what I was doing. By that time, I had built my position up to about 10 or 15 contracts. The margin on a single outright contract was $2,000, while the spread margin was only $400. He told me, "The spread position you have on trades like an outright long position. I'm going to raise your margins from $400 to $2,000 per contract." Spread margins are lower than outright margins, reflecting the assumption that a net long or short position will be considerably more volatile than a spread position. Reason: in a spread, the long contract portion of the position is likely to at least partially offset price movement in the short contract position. In a shortage situation, however, an intercrop spread, such as long July soybeans, short November soybeans, can prove to be nearly as volatile as a net long or short position. He was obviously quite concerned with the risk in your position. Yes, he was concerned that I'd only put up $400 margin per spread on a spread which behaved like a net long position. Actually, he wasn't that far off. He was right, but I was furious, so I moved my account to another brokerage firm, which shall remain nameless for reasons that will soon become clear. You were furious because you felt he was being unfair, or... Well, I'm not sure I thought he was being unfair, but I certainly knew he was an obstacle to my objective. I moved my account to a major brokerage house, and got a broker who was not very competent. The market kept moving up, and I kept adding to my position. I had put on my first spread on February 25. By April 12, my account was up to $35,000. Were you just adding to your position as the market went up, or did you have some plan? I had a plan. I would wait until the market moved up to a certain level and then retraced by a specific amount before adding another unit. My pyramiding did not turn out to be the problem. The market had entered a string of limit-up moves. On April 13th, the market hit a new record high. The commotion was tremendous. My broker called me at home and said, "Soybeans are going to the moon. It looks like July is going limit up, and November is sure to follow. You're a fool to stay short the November contracts. Let me lift your November shorts for you, and when the market goes limit up for the next few days, you'll make more money." I agreed, and we covered my November short position. All of it? All of it. Was this a spur-of-the-moment decision? It was a moment of insanity. 15 minutes later, my broker calls me back, and he sounds frantic. "I don't know how to tell you this, but the market is limit down. I don't know if I can get you out." I went into shock. I yelled at him to get me out. The market moved off of limit down by a little bit, and I got out. Did you end up getting out at limit down? I got out between limit down and slightly above limit down. I can tell you the dimensions of the loss. At the moment I covered my short November position, leaving myself net long July, I was up about $45,000. By the end of the day, I had $22,000 in my account. I went into emotional shock. I could not believe how stupid I had been, how badly I had failed to understand the market, in spite of having studied the markets for years. I was sick to my stomach, and I didn't eat for days. I thought that I'd blown my career as a trader. But you still had $22,000 compared to your original stake of only $3,000. Keeping things in perspective, you were still in pretty good shape. Absolutely, I was in good shape, but was it the stupidity of the mistake, or was it the money that you had given back that caused such emotional pain? No, it wasn't the money at all. I think it was the realization that there really was fire there. Until then, I had ridden $3,000 to $45,000 without a moment of pain. On the way up, did you think, this is easy? It was easy. Did you give any thought to the possibility that the market streak could eventually go the other way? No, but clearly my decision to lift the short side of my spread position in the middle of a panic showed a complete disregard for risk. I think what bothered me so much was the realization that I had lost a process of rationality that I thought I had. At that moment, I realized that the markets were truly capable of taking money away every bit as fast as they gave it to you. That made a very strong impression on me. Actually, I was very lucky to get out with $22,000. I assume that your quick action that day probably averted a complete disaster. Absolutely. After that day, the market went straight down as fast as it had gone up. Perhaps if I hadn't made my stupid mistake, I might have made the mistake of riding the market down. What eventually happened to the spread? The spread collapsed. Eventually, it went below the level that I had first begun buying it at. Since you liquidated your position on the day the market and the spread topped, you would have given back a portion of the profits, even if it wasn't for the disastrous decision that forced you out of the market. That may be true, but for me that was my going bust trade. It was the closest I ever came to going bust, and psychologically it felt as if I had. Was that your most painful trade? Yes, far and away, even though you actually ended up making a substantial amount of money on the trade. I multiplied my money by nearly six-fold on that trade. I was, of course, insanely leveraged, and I didn't understand how risky my position was. Was getting out of your entire position immediately after your broker called to tell you the market was limit down a matter of panic, or do you think you had some instinctive common sense about controlling risk? I'm not sure. At that moment I was confronted with the realization that I had blown a great deal of what I thought I knew about discipline. To this day, when something happens to disturb my emotional equilibrium and my sense of what the world is like, I close out all positions related to that event. Do you have a recent example? October 19th, 1987, the week of the stock market crash. I closed out all my positions on October 19 and 20 because I felt there was something happening in the world that I didn't understand. The first rule of trading, there are probably many first rules, is don't get caught in a situation in which you can lose a great deal of money for reasons you don't understand. Let's get back to the period after your soybean trade. When did you start trading again? About a month later. After a few months, I had my account back to about $40,000. Around that time, I answered an ad for a trading assistant position at Commodities Corporation. I was interviewed by Michael Marcus in his usual idiosyncratic manner. He had me return to Commodities Corporation several weeks later. Well, he said, I have some good news and some bad news. The bad news is that we are not hiring you as a trading assistant. The good news is that we are hiring you as a trader. How much money did Commodities Corporation give you to trade? $35,000. Were you trading your own money as well at the same time? Yes, and that is something that I'm very glad about. Commodities Corporation had a policy that allowed you to trade your personal account as well as the company account, and Michael and I were very aggressive traders. Were you influenced by Michael? Oh, yes, very much. Michael taught me one thing that was incredibly important. That's a great lead-in. What's the punchline? He taught me that you could make $1 million. He showed me that if you applied yourself, great things could happen. It is very easy to miss the point that you really can do it. He showed me that if you take a position and use discipline, you can actually make it. It sounds like he gave you confidence. Right. He also taught me one other thing that is absolutely critical. You have to be willing to make mistakes regularly. There's nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money. You are one of the most successful traders in the world. There are only a small number of traders of your caliber. What makes you different from the average guy? I'm not sure one can really define why some traders make it while others do not. For myself, I can think of two important elements. First, I have the ability to imagine configurations of the world different from today and really believe it can happen. I can imagine that soybean prices can double or that the dollar can fall to 100 yen. Second, I stay rational and disciplined under pressure. Can trading skills be taught? Only to a limited extent. Over the years, I've tried to train perhaps 30 people, and only 4 or 5 of those have turned out to be good traders. What happened to the other 25? They are out of the business, and it had nothing to do with intelligence. When you compare the trainees that made it to the majority that did not, do you find any distinguishing traits? They are strong, independent, and contrary in the extreme. They are able to take positions others are unwilling to take. They are disciplined enough to take the right size positions. A greedy trader always blows out. I know some really inspired traders who never managed to keep the money they made. One trader at Commodities Corporation, I don't want to mention his name, always struck me as a brilliant trader. The ideas he came up with were wonderful. The markets he picked were often the right markets. Intellectually, he knew markets much better than I did, yet I was keeping money and he was not. So where was he going wrong? Position size. He traded much too big. For every one contract I traded, he traded 10. He would double his money on 2 different occasions each year, but still end up flat. Do you always use fundamental analysis in forming your trading decisions? I almost always trade on a market view. I don't trade simply on technical information. I use technical analysis a great deal, and it's terrific, but I can't hold a position unless I understand why the market should move. Is that to say that virtually every position you take has a fundamental reason behind it? I think that's a fair statement, but I would add that technical analysis can often clarify the fundamental picture. I'll give you an example. During the past 6 months, I had good arguments for the Canadian dollar going down and good arguments for the Canadian dollar going up. It was unclear to me which interpretation was correct. If you had put a gun to my head and forced me to choose a market direction, I probably would have said down. Then the U.S.-Canadian Trade Pact was announced, which changed the entire picture. In fact, the market had broken out on the upside a few days earlier as the negotiations were finishing up. At that instant, I felt completely comfortable saying that one of the major pieces in the valuation of the Canadian dollar had just changed, and the market had already voted. Prior to the agreement, I felt the Canadian dollar was at the top of a hill, and I wasn't sure whether it was going to roll backwards or forwards. When the market moved, I was prepared to go with that movement because we had a conjunction of 2 important elements, a major change in fundamentals, although I wasn't smart enough to know in which direction it would impact the market, and a technical price breakout on the upside. What do you mean you weren't smart enough to know in which direction the trade pact announcement would move the market? Since U.S.-Canadian trade is so much a larger component of Canadian trade than it is of U.S. trade, wouldn't it have been logical to assume that the trade pact would be bullish for the Canadian dollar? It didn't have to happen that way. I could just as easily have argued that the trade pact was negative for the Canadian dollar because the elimination of the trade barriers would allow imports from the U.S. to submerge Canadian interests. There are still some analysts who adhere to that argument. My point is, there are well-informed traders who know much more than I do. I simply put things together. They knew which way to go, and they voted in the marketplace by buying Canadian dollars. Is the generalization of that example that when an important fundamental development occurs, the initial direction of the market move is often a good tip-off of the longer-term trend? Exactly. The market usually leads because there are people who know more than you do. For example, the Soviet Union is a very good trader. Good trader in which markets? In currencies and grains to some degree. How does one know what the Soviets are doing? Because the Soviets act through commercial banks and dealers, and you hear about it. It seems rather contradictory to me that a country that is so poor in running its own economy should be a good trader. Yes, but if you ask people in the business, you will find out that they are. Why or how? It is a joke, but perhaps they do read some of our mail. The Soviets and other governments occasionally have advance information. Well, why shouldn't they? They have the best developed intelligence service in the world. It's a well-known fact in the intelligence community that the Soviets and others are capable of eavesdropping on commercial communication. That is why the large commodity trading firms sometimes use scramblers when they are making very sensitive calls. My point is, there are thousands of difficult-to-understand mechanisms that lead the market, which come into play before the news reaches some poor trader sitting at his desk. But the one thing that does hit the market is a huge sale or purchase. Isn't that the basic rationalization for technical analysis? Technical analysis, I think, has a great deal that is right and a great deal that is mumbo-jumbo. That's an interesting statement. What's right and what's black magic? There's a great deal of hype attached to technical analysis by some technicians who claim that it predicts the future. Technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. But of course that would be sheer folly. If you are a responsible participant in the market, you always want to know where the market is, whether it's hot and excitable or cold and stagnant. You want to know everything you can about the market to give you an edge. Technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. It's very important for me to study the details of price action to see if I can observe something about how everybody is voting. Studying the charts is absolutely crucial and alerts me to existing disequilibria and potential changes. Do you sometimes put on a trade because you look at a chart and say, I've seen this pattern before, and it is often a forerunner of a market advance? That is, even though you may not have any fundamental reasons. Yes, I'll do that sometimes. I would only add that as a trader who has seen a great deal and been in a lot of markets, there's nothing disconcerting to me about a price move out of a trading range that nobody understands. Does that imply you usually go with breakouts? Sure, but the markets are often prone to false breakouts. There has to be more to it than that. Tight congestions in which a breakout occurs for reasons that nobody understands are usually good risk-reward trades. How about breakouts that occur because there is a story in the Wall Street Journal that day? That would be much less relevant. The Heisenberg principle in physics provides an analogy for the markets. If something is closely observed, the odds are it is going to be altered in the process. If corn is in a tight consolidation and then breaks out the day the Wall Street Journal carries a story about a potential shortage of corn, the odds of the price move being sustained are much smaller. If everybody believes there is no reason for corn to break out, and it suddenly does, the chances that there is an important underlying cause are much greater. It sounds like you're saying that the less explanation there is for a price move occurring, the better it looks. Well, I do think that. The more a price pattern is observed by speculators, the more prone you are to have false signals. The more a market is the product of non-speculative activity, the greater the significance of technical breakouts. Has the greatly increased use of computerized trend-following systems increased the frequency of false technical signals? I think so. The fact that there are billions of dollars out there trading on technical systems that use moving averages or other simple pattern recognition approaches helps produce many more false signals. I have developed similar systems myself so that I can tell when the other systems are going to kick in. If it is clear that prices are moving because these billions are kicking into the market, it's a lot less interesting than if a breakout occurs because the Russians are buying. Let's say you do buy a market on an upside breakout from a consolidation phase, and the price starts to move against you, that is, back into the range. How do you know when to get out? How do you tell the difference between a small pullback and a bad trade? Whenever I enter a position, I have a predetermined stop. That's the only way I can sleep. I know where I'm getting out before I get in. The position size on a trade is determined by the stop, and the stop is determined on a technical basis. For example, if the market is in the midst of a trading range, it makes no sense to put your stop within that range, since you are likely to be taken out. I always place my stop beyond some technical barrier. Don't you run into the problem that a lot of other people may be using the same stop point, and the market may be drawn to that stop level? I never think about that because the point about a technical barrier, and I've studied the technical aspects of the market for a long time, is that the market shouldn't go there if you are right. I try to avoid a point that floor traders can get at easily. Sometimes I may place my stop at an obvious point if I believe that it is too far away or too difficult to reach easily. To take an actual example, on a recent Friday afternoon, the bonds witnessed a high-velocity breakdown out of an extended trading range. As far as I could tell, this price move came as a complete surprise. I felt very comfortable selling the bonds on the premise that if I was right about the trade, the market should not make it back through a certain amount of a previous overhead consolidation. That was my stop. I slept easily in that position because I knew that I would be out of the trade if that happened. Talking about stops, I assume because of the size that you trade, your stops are always mental stops, or is that not necessarily true? Let's put it this way. I've organized my life so that the stops get taken care of. They are never on the floor, but they are not mental. What eventually tells you that you are wrong on a major position trade? Your stop point will limit your initial loss, but if you still believe in the fundamental analysis underlying the trade, I assume that you will try it again. If you are wrong about the general direction of the market, won't you take a series of losses? At what point do you throw in the towel on the trade idea? First of all, a loss of money itself slows me down, so I reduce my positions. Secondly, in the situation you described, the change in the technical picture will give me second thoughts. For example, if I am bearish on the dollar and a major intermediate high has been penetrated, I would have to reevaluate my view. Earlier, you mentioned that you had developed your own trend-following systems to provide an indicator of where the large amount of money managed under such systems could be expected to hit the market. Do you use your own trend-following systems to trade any portion of the money you manage? Yes, about 5%. Is that the level of your confidence? I guess it is not negative 5%, so it could be worse. Overall, my systems make money, but they have some volatility characteristics and problems related to risk control that I don't like. But since they offer diversification from my other trading, I use them to a small degree. Do you feel it is possible to ever develop a system that would do as well as a good trader? I think it's unlikely because the learning features of such a system would have to be very highly developed. Computers are good at learning only when there are clear hierarchies of information and precedent. For example, expert systems for medical diagnostics are very good because the rules are very clear. The problem with developing expert systems for trading is that the rules of the trading and investment game keep changing. I've spent some time working with expert system developers, and we concluded that trading was a poor candidate for this approach, because trading decisions encompass too many types of knowledge, and the rules for interpreting the information keep changing. Does the fact that you are trading so much greater size than you did in your early years make it more difficult? There are far fewer markets with sufficient liquidity for the optimum size of my trades. How much money are you currently managing? Over $650 million. I assume more than half of that is due to capital appreciation. Well, yes, last year's profits alone were about $300 million. What are some markets that you really have trouble trading because of insufficient liquidity? An example of a market I like a great deal, but in which the liquidity is often poor, is copper. In copper, I'm now the elephant. What kind of size can be moved comfortably in a market like copper before it becomes a problem? I would say in a day you can comfortably move 500 to 800 contracts, uncomfortably somewhat more than that. But the daily volume of copper is currently only 7,000 to 10,000 contracts, and a lot of that is local trading or spreads. In contrast, in the T-bond market, you can move 5,000 contracts without a problem. You can also move very large size in the interbank currency market. Can you trade a market like coffee, which doesn't have deep liquidity but sometimes can develop enormous trends? Yes, I did trade coffee last year and made a few $1,000,000 in it. Now if I'm managing $600 million and I kick in $2 million in profits on coffee trades, it doesn't really matter that much. In fact, it could even be counterproductive since the time and energy I spend concentrating on coffee diminishes my focus on the currency markets, which I trade far more heavily. It would appear that you have reached a size level that impedes your trading performance. Since you have substantial personal funds, did you ever consider just trading your own money and avoiding all the related headaches in managing money? Yes, but there are several reasons why I don't. Although I invest a great deal of my own money in my funds, the portion of my funds that is managed money represents a call. analogy to an option that has unlimited profit potential in the event of a price rise, but risk limited to its cost in the event of a decline. I don't say this to be flippant, since my reputation among my investors is extremely important to me, but a call is a much better position than a symmetrical win-lose position.
Is there a practical limit to the amount of money you can manage?
In most commodity futures markets, there certainly is. However, in currencies, interest rates, and a few commodities, such as crude oil, there are limits, but they are very high. I plan to very carefully manage the future growth and the size of funds I am managing.
When you put in orders in markets that are not among the most liquid, in other words, not T-bonds or the major currencies, do you find your orders actually moving the market?
They can, but I never bully a market.
Talking about that, one often hears stories about very large traders trying to push the markets up or down. Does that work?
I don't think so. It can be done for the short term, but eventually it will lead to serious mistakes. It usually results in arrogance and a loss of touch with the underlying market structure, both fundamentally and technically. The traders that I know who thought too highly of their ability and tried to bully the market ultimately made the mistake of overtrading and went under.
Without mentioning any names, can you provide an example?
There is a recent example of a British trading organization getting into serious trouble after they tried to corner the crude oil market. At first they succeeded, but then they lost control and crude oil prices fell by $4.
What was the end result?
They lost about $40 million, and the organization is in trouble.
You're probably managing more money than any other futures trader in the world. How do you handle the emotional strain when you hit a losing period?
The emotional burden of trading is so substantial, on any given day I could lose millions of dollars. If you personalize these losses, you can't trade.
Do the losses bother you at all anymore?
The only thing that disturbs me is poor money management. Every so often I take a loss that is significantly too large, but I never had a lot of difficulty with the process of losing money, as long as losses were the outcome of sound trading techniques. Lifting the short side of the July-November soybean spread was an example that scared me. I learned a lot about risk control from that experience, but as a day-in, day-out process, taking losses does not bother me.
Did you have any losing years?
Yes, in 1981 I lost about 16%.
Was that due to errors you made or the nature of the markets?
It was a combination of the two. My main problem was that it was the first major bear market in commodities I had experienced, and bear markets have different characteristics than bull markets.
Was it a matter of becoming complacent about markets always being in an uptrend?
No, the problem was that the principal characteristic of a bear market is very sharp down movements, followed by quick retracements. I would always sell too late and then get stopped out in what subsequently proved to be part of a wide-swinging congestion pattern. In a bear market, you have to use sharp counter-trend rallies to enter positions.
What other mistakes did you make that year?
My money management was poor. I had too many correlated trades.
Was your confidence shaken at all that year? Did you go back to the drawing board?
I went back and designed a lot of risk management systems. I paid strict attention to the correlations of all my positions. From that point on, I measured my total risk in the market every day.
When you trade currencies, do you use the interbank market or the futures market?
I only use the interbank market unless I am doing an arbitrage trade against the IMM. The International Monetary Market, IMM, is a subsidiary of the Chicago Mercantile Exchange and the world's foremost currency futures exchange. The liquidity is enormously better, the transaction costs are much lower, and it is a 24-hour market, which is important to us because we literally trade 24 hours a day.
What portion of your trading is in currencies?
On average, about 50 to 60% of our profits come from currency trading.
I assume you're also trading currencies beyond the 5 that are currently actively traded on the IMM.
We trade any currency that is highly liquid, virtually all the European currencies, including those of the Scandinavian countries, all the major Asian currencies and the Mideast currencies. Crosses are probably the most important trading vehicle that we use that you can't trade on the IMM. Crosses are a trade involving two foreign countries. For example, buying British pounds and selling an equal dollar amount of Dutch marks is a cross. You can't trade crosses on the IMM because they have fixed contract sizes.
But you could do a cross on the IMM by adjusting the ratio of the number of contracts between the two currencies to equalize the dollar value of each position.
But it's much more exact and direct to use the interbank market. For example, Dutch mark, British pound, and Dutch mark Japanese yen crosses are highly traded and very active. I assume that when you do a mark-yen cross, you price it in dollars, not in terms of one of the two currencies. That's right. You simply say, buy $100 million worth of marks and sell $100 million worth of yen. In the interbank market, the dollar is the unit of exchange all over the world. In situations where a surprise news development or the release of an economic statistic out of line with expectations causes a sharp rise response in currencies, does the interbank market react less violently than the futures market, or do the arbitrateurs keep the two markets tightly linked? The two markets are well arbitraged, but those are the moments when a very swift arbitrager will make some money. The markets do get a little bit out of line, but not a lot. Will the interbank market price response to such events be less extreme? Yes, because what happens on the futures market is that the locals back away and let the stops run. The only thing that pulls the markets back is the arbitrageurs who have the bank on the other side. What percentage of bank market trading represents commercial activity or hedging vis-a-vis speculative trades? The Fed has done a study on that. I don't have the figures on hand, but it is basically a hedging market. The banks are the principal speculators, as well as a few players like myself. Is there a reason why the futures market hasn't been able to capture a larger percentage of world currency trading? The currency futures market is not efficient in several of the most important respects. First, hedging usually has a specific dollar and date requirement. For example, if I need to hedge $3.6 million for April 12, the bank just takes it. The futures market, however, trades only for specific dates and fixed contract sizes, so the hedger is not precisely covered. So actually, there's no way the futures market can compete, because the interbank market can tailor a hedge for any customer. That's right. In addition, the activity takes place within normal commercial banking relations. That is, very often, the hedger wants to show his banking interest that he has a locked-in profit so he can borrow against it. Can you talk about your fundamental analysis methodology? How do you determine what the right price for a market should be? I assume that the price for a market on any given day is the correct price. Then I try to figure out what changes are occurring that will alter that price. One of the jobs of a good trader is to imagine alternative scenarios. I try to form many different mental pictures of what the world should be like and wait for one of them to be confirmed. You keep trying them on one at a time. Inevitably, most of these pictures will turn out to be wrong. That is, only a few elements of the picture may prove correct. But then, all of a sudden, you will find that in one picture, 9 out of 10 elements click. That scenario then becomes your image of the world reality. Let me give you an example. The Friday after the October 19 stock market crash, I had trouble sleeping, which is very unusual for me. But I'm sure I wasn't the only trader to lie awake that night. All week long, I struggled with how the events of that week were going to impact the dollar. I was trying on different visions of the world. One of these pictures was total panic, the world coming to an end financially. In this scenario, the dollar becomes the safest political haven, and as a result, there could be a tremendous rise in the dollar. In fact, on Tuesday of that week, the dollar did rise dramatically, as many people withdrew their money from other places. During the next 3 days, there was tremendous confusion. By the end of the week, the dollar had started to give ground again. It was then that it all coalesced in my mind. It became absolutely clear to me that given the combination of a need for stimulative action, dictated by the tremendous worldwide financial panic, the reluctance of the Bank of Japan and German Bundesbank to adopt potentially inflationary measures, and the continuing wide U.S. trade deficits, the only solution was for Treasury Secretary Baker to let the dollar go. Someone had to play the stimulative role, and that someone would be the United States. As a result, the dollar would drop, and it would not be in the interest of the other central banks to defend it. I was absolutely convinced that was the only thing that Baker could do. You realize all this late Friday. Was it too late to take action in the markets? Yes, and it was a very tense weekend because I realized that the dollar might open sharply lower. I waited for the Far East